Cohn is back on with us. He is, of course, founder of Money Sherpa. Mark, good morning to you.
Good morning, Greg.
Hopefully I have you for longer than I did a couple of minutes ago. Right.
Okay.
So talk to me about, well, I was asking a question yesterday really out loud because, but you're an expert, you can let me know. Some of the conversations we're having now feel very much pre-crash, the late noughties. Now, I know things are different, but some of it feels the same. Now, we have a small amount of housing available, very, very little, okay? And the price is going up, and maybe now it's starting to top out, right? And maybe even it was starting to come back down. And lo and behold, now we have the central bank saying we're going to make it easier for people to borrow money. So if you've got more people able to buy the same amount of houses, that pushes up house prices, surely, does it not?
Yeah, I think the reality is this move will probably have the impact of pushing up housing. And I understand the debate that most people instantly react that must be a bad thing. I think there is a subtlety here that may be getting lost in the noise. And I understand why, because of the situation back in 2008. But higher house prices kind of counterintuitively don't necessarily mean lower house affordability. So if effectively you're increasing the credit, so people's ability to access funds, and also at the same time, with things like the First Home Scheme, you're actually giving people a leg up in terms of government grants so that they can afford more, then they can still be more likely to afford a house, but the house price can be higher. And I think what the government's trying to do here is keep affordability, the government and the central bank, I should say, keep affordability high, or maybe even make it higher, but also kind of deliberately push house prices a little bit higher. And I think the reason that they're trying to do that is so that housing developers, people looking at building, actually make a little more profit. And I know people will probably hold their hands up and say, the last thing we want is developers making more profit. But the reality is, because the building costs in Ireland are so high and they're not likely to come down with inflation, they're actually getting higher day by day. What the people who develop houses are doing is they're looking at projects and they're making a decision. Do they make enough profit on each of these deals?
And I think also part of their thinking as well, correct me if I'm wrong, is that some developers, but if you think about it, you can understand it, but on the face of it, it doesn't make any sense. Some developers are saying that currently there's not enough people out there able to buy the houses that they're proposing to build. And I thought through this a little bit yesterday. I can understand, because obviously, you know, you could have an awful lot of people able maybe to buy a house at 150 grand or 175 if you can pick one up in Donegal at that price. But for these houses that are being built maybe on commuter belts or in other parts of the country, there's not an awful lot of people maybe can afford 3 or 350, but a change like this pushes them into the market and allows them to buy houses, justifying the building of these houses. Is that kind of it? Yeah.
No, you're 100% right, Greg. And I think the other thing. So that's the first thing. And I think the quality of the debate around this is. I mean, I understand the worry about 2008 and the credit bubble, but there are some huge differences, and I think this is what the central bank have in mind in the credit situation and in the rules around lending now, as opposed to back in 2008. So back in 2008, frankly, it was the Wild West. I mean, we all know the stories of brokers saying, well, what should I put your income down as? You know, the idea of any sensible lending going back on in those days, it just didn't happen. Now there's actually a rigorous due diligence process that's enforced by the lenders, which was being enforced by the central bank. We also have capital requirements on the banks, which were never there, that have been imposed on by the European Central Bank, by Frankfurt. And the cost of credit is also higher. And the other thing here is that the central bank hasn't said, let's scrap the LTI limits. It said, let's increase them from 3.5 to 4. All that does is bring us into line with the limits that are in place around Europe. We actually there's
only a couple of countries, us, Britain and one other, is it Sweden? One other country that actually has calculators against our income versus mortgages. The majority of Europe actually don't employ the system that we do.
No, that is correct. So we have, what some people refer to as a double handbrake. We have the lending criteria that the lenders use, and then on top of this, we have this safety net as well. So this kind of is a sensible move in my view. It is to be welcomed. I think whether it actually leads to more houses being built, is an open question. I think that's certainly in the intention. I think the one other point that I'd make, and this is a big bugbear of mine, is what that 3.5 limit was doing was locking out a lot of renters. So we did a survey in the summer. Money Sherpa did a survey in the summer, and we found that the majority of renters were paying $1,000 a month more in rent than they would be paying in a mortgage payment, because they were trapped by this 3.5 loan to income. So they were paying what they could pay in a repayment. They could get a long-term 20-year fixed loan where they know their repayments, but they couldn't get on the housing ladder because of these constraints and because of these limits. And that is hugely unfair, because effectively what you're taking is the renters who are typically lower socioeconomic, lower income, and you're saying, well, you're just going to have to keep paying this dead money, and you are just going to be impoverished continually by that. And we're all right because we have high enough income, and we can go and buy a house, and we can build our family rent and our family well. And I think that was something that was deeply wrong.
So between
basically,
these,
Greg, I'm glad to see the back of this.
Yeah, exactly. So between these changes and a couple of government initiatives, first-time buyers, they can if you're on about 65, if you and a partner are on about 65, probably get a mortgage close to 400 grand, couldn't you, with the 4 times salary and the first-time buyer grants and initiatives that are there?
Yeah, I mean, there's been, in fairness, and I'm not being supportive of anybody politically here.
It's perfectly okay. There's plenty of criticism. So if you want to sing the government's praises from the rafters, feel free, Mark. There's no shame in that game either.
I'm definitely not here to do that.
All right.
But what I am there to say is there has been some positive policy moves. So I think this isn't the government. This is the central bank. Yeah. I think it's a positive. I think they could have gone further, actually, but they need to make sure they're covered. They don't want a 2008 again. And I understand why they've just gone to the 4. I think that's rational. I think the first home grant is really significant. We're not seeing. I think that'll be slow to get out there in terms of people being aware of. But that's 30%. I shouldn't say it's an equity scheme. It's not a grant. It's 30% of the purchase price you can get funded by the government. Effectively, an almost interest-free loan. So that's not in the mortgage. So you get that 30%, that starts you off. You've still got the help, the first-time buyers grant as well. So the grant as well.
That's 30 grand, is it?
Yeah, so that's 30 as well. And then you've got, this more slack. Now, okay, everybody's going, some people might be thinking, oh my God, that's higher house prices. But as we've just discussed, if you've got higher affordability and that leads to more houses being built ultimately, that's not a bad.
There's no point 1,000 people being able to buy a car for €1,000 when really need a car for €2,000. So what you have to do is you have to bring people up to now that means the cars go to 2,300. That's part of it, but that's how you get people on the property ladder. Couple of quick questions. Is it too late, or people should they be fixing now? We asked this before. It's very hard to know when the right time is. We've seen the crazy antics, what's happening in Britain at the moment, and I feel so much for people coming off deals, people that got mortgage approvals. I mean, the cost of that mortgage is... Anyway, but here, we'll focus here in the Republic. We are seeing banks increasing their rates now, 2 or 3 increases. Is now the time to fix? Do we know when they might top out, if you can fix?
Yeah. I mean... What I always say is, if if you're worried at all about not being able to make your repayments or making a hole there in your finances, then you should definitely think about fixing. To your question, Greg, definitely not too late, although we are running out of time. So,
what kind of fixing deals are out there at the moment, Mark?
You can still fix at 2.5% on average. There's even some down to 1.9.
I think some people are actually probably paying that. I know what I are probably paying more than 2.5 because they never really checked what deals were available with their mortgage lender and just sat there maybe paying 3.95 or something.
100%. So there are 175,000 people right now who are paying an average of 3.6. And there are fixed deals on the market right now from 1.9 and with an average of 2.5. And they could be saving 15,000 a year. Now, I do think they're not going to be around for very much longer.
I think people should move on that because, as well, too, at the moment, it also depends on your loan to value ratio. But I just think if you can get certainty on one thing, and as a homeowner, you're really lucky if you can get locked in and have certainty compared to a renter, for example, that's at the whim of the markets. And one other question too: what's the story with people on trackers? Trackers obviously were all the rage with a brilliant thing and what have you. But now what's happening is people are seeing their mortgages increasing really quite significantly. They go to see if they're eligible for a fix, and no, you're ineligible. So in the last minute and a half that we have, Mark, what is the situation with people on trackers and fixing, or are they stuck, or it depends on how long they've taken out the tracker for? I don't understand it. What's the story?
Yeah, so essentially, there's two categories, right? So a tracker is a variable mortgage. Now, it was a great deal variable mortgage, but it is still variable. And as rates rise, a lot more of the people on trackers will actually find themselves going above fixed rates. So I'm actually advising anybody who's on a tracker right now to talk to a broker, because it'll all depend on...
Does it mean switching your mortgage, though? Because, as I say, some people I know, they've went to the bank and they've said, well, you're in a tracker, you're not eligible for a change.
Okay. Well, the first thing is that isn't true. If you're on a tracker, you are eligible to change.
Right.
You may not be able to change because you might not be able to afford, you might not pass the affordability criteria that we've just talked about earlier on. But if you talk to a broker, they can probably tell you in 50 minutes, 20 minutes, a broker who's got access to all the lenders, they'll be able to give you an assessment on that. And then at least you'll know where you are.
Brilliant.
It may be the case that you end up paying a little bit more in the short term.
But you have the certainty.
But you have the certainty.
There is always an element of risk with all of this. Mark Cohn, as always, founder of Money Sherpa, thank you so much for your time this morning. We really appreciate it.
Thanks, Greg.
All right, take care of yourself. All right, that is some of your questions answered as it relates to mortgages. Okay.